FedEx was down almost 6% at one point after hours. Now they're only down 2.4%. They reported their earnings. Well, first off, CFO is retiring, and they're going to do an external search for a new CFO. They reported $4.94 per share in profit, beating the estimate of 47, but their revenue fell a little short. $21.9 billion, missed on $22.66 billion in revenue. But they're down a lot because of guidance. They're expecting flat to single-digit growth over the next year for revenue and EPS of $16.50 to $18.50 per share. Now, let's jump to what analysts were looking for next year. Analysts were looking for, see, that's the thing. That's interesting. Like, our analysts here are expecting, for next year, $18.50. Okay. So they're on the low end of that. The $18.50 is the high end of their estimation. All right, so that's why. Guys, FedEx, you could argue, is an economic indicator. When people are shipping lots of stuff, buying lots of stuff, that's a good indication of things. Take it however you want. I'm not going to get in the game of, are we in a recession? Are we not? The yield has inverted, all that stuff. So if you're new to the channel, watch the video. Whether you're a beginner or an advanced investor, we have something for everybody. We're going to go through analyst estimates a little bit further. We're going to go through our 8-pillar process. We're going to talk about the high level of the company, some high level financials of the business, and then we're going to end it with the stock analyzer tool. That's our most popular product, and what that does is it allows you to make assumptions about the future, and then the stock analyzer tool, not including the balance sheet, will tell you on a discounted cash flow basis what price to pay for the company. So let's check out some of the main metrics for FedEx. It is a $58 billion market cap business. That means if you bought every share outstanding, you'd have to pay $58 billion to own every share. But look right here, the enterprise value is $114 billion. That difference between enterprise value and market cap is essentially their net debt. All right, fine. Dividend. Pays a decent dividend, 2%. It's above the market. It pays about $1 billion. Now, I will say this. Their 5-year average free cash flow is $1.9 billion. So their dividend eats up over 50% of the 5-year average free cash flow. We like it to eat up less than 50%, but it is what it is. It's not far off. Low profit margins, guys. 5-year average, 3.6%. 1 year of 3.2. They do have about $1.6 billion in cost-cutting efforts that they're trying to initiate as part of this. So if you're interested further, I'm sure they're going to have their earnings call here shortly. By the time this video goes out, it's 4:40 p.m. Eastern time right now. I imagine this video will be out in the next half hour, 45 minutes. They would probably have started their earnings call, and who knows what the stock would have done by then. It's pretty stable right now. Guys, these aren't big margins. 21% gross margin. That means for every dollar they sell, they only get 21 cents that can be used for paying down to the bottom line before you get overhead and before you pay your income taxes. So it's not huge. Like Microsoft is 68%, and it's a totally different business. But that's pretty much, it's not really great, but that's why their price to sales ratio is so low. Guys, I don't like this. A very low return on invested capital. This is a very important metric for value investors. When it comes to a long-term hold, this return on invested capital says this is the money that when they reinvest the capital that's in the business, this is the return they can make. This is crap, guys. This is crap. So I would encourage FedEx, as much as possible, to buy back cheap shares and to issue a dividend. Don't invest it. You guys aren't good at investing it. This tells me you're not very good at investing it. All right? That's what I don't like. And guess what? The stock isn't cheap. The 1-year PE is 19.5. The 5-year PE is 20. It's not very cheap. So, okay, I'm looking at that saying, all right, it's not like it's in cheap territory where they can buy back a lot of shares. I guess I like the dividend being paid out because I don't like this at all. Guys, the market average is 9 or 10%. You know, some of the companies we like are 20% plus return on invested capital. That means for every dollar they invest in the business, they get a 20% return. So that's the question you have to ask yourself. Do you want them to be investing your cash? I don't know about that. Okay, let's check out the 8 pillars here. 4 X's, 4 checks. So here's something interesting. Net income in the last 5 years is down $644 million, but cash flow is up. That's interesting. That's very interesting. And look at this debt level. 25 times their 5-year average free cash flow. Wow. It's a big number, guys. That's a big stinking number. That's a big number. High multiple of free cash flow, but a low multiple of earnings. I don't like that. What this means here is that they're reporting higher earnings over the last 5 years than free cash flow. Because in order for the multiple to be lower, it must have a higher number. I don't like that. Overall, guys, I'm blah on this. And Mo, if you watch our show, you know Mo hates FedEx because he's always worried about his I've never had a problem with FedEx. Mo has every problem in the sun with FedEx. Who knows what that's all about? So let's see, go back to the analyst estimates. Oh, wow. Big jumps in profit. $15 they estimated for this year. What did they end up reporting? Like $16.50 or $16 for the year? I don't remember, but $15 here, growing to $32 in 5 years. Hell, take that times 15. That's a what is that? $480 share price. And they're currently at what? Did I do that math right? I think I did. And they're currently at 226. All right. If you believe that, if you believe they can do this, that's a lot of EPS growth. Look at their revenue growth. Not very. So how are they going to drive so much profit? How are they going to get so much in EPS growth when their gross margin and profit margin are so low? That only is going to happen by buying back a crap ton of shares. And their stock isn't super cheap where I'm like, yeah, buy it back. You look at the example of NVR, the home builder. Their stock's selling for 11 times. It was selling for 4 times in the past. It doesn't sell for a very high multiple, so buying back shares makes a lot of sense. This doesn't really make a lot of sense. Why buy back expensive shares? So how do you get to, well, for one thing, well, man, both analysts here, pretty high numbers. I don't get this. How do you get such a big EPS without such a big revenue growth number and with such low margin? Interesting. Very, very interesting. I don't understand that. I'm very, very confused by this. All right, let's go to the Stock Analyzer tool. Guys, most popular part of our site. It was used 1.3 million times in 2022 by our users. I don't know what the numbers are this year, but I'm sure it's probably higher. So guys, we're going to make assumptions about the future. And it's really, really, really important that when you make assumptions, you have a wide range. And the reason being is we don't know the future. You have no idea what's going to happen. All you can do is say, okay, what does the future hold? Now, I do a 10-year analysis or a 20-year analysis. I actually might do a 20-year analysis on FedEx because I don't want to sit there and think about this upcoming recession and how it's going to affect things. And I want to look at FedEx from a long-term perspective. So what's the world likely to look like in 20 years? I'm going to have low and I'm going to have high assumptions. Now remember, the further out you go, the more spread out your results will be, right? If it was 5 years, it'd be here, 10 years here, 20 years here. It's a shotgun, right? So remember that when you look at these numbers. But our goal is to discount the cash flow because every investment is the present value of all future cash flows. If you don't understand what that means, very simply, you have to take all the cash flow you get in the future and present value it today at a certain rate of return. That is the price you should pay. And that's where we put our desired return in here. That's where we put our desired return in here. That's the big key. Okay? So we're going to make these assumptions. I mean, look at this. This is interesting. Revenue growth. Man, I'm just surprised by this. But let's make our assumptions here. So for revenue growth for 20 years, I'm going to go 3, 5, and 7%. 3%, 5%, 7%. Amazon is taking things off. They're doing their own shipping. I don't know. I think it's a very mature company, FedEx. I would be surprised to see them. That would be doubling 2 times the next 20 years on the high side. So it'd be 4x revenue. 4x revenue would take them to what? What are they doing revenue now? Like $100 billion? Is that what it is? Yeah, 93 billion. So it would take them to 360 billion. Okay. I could see that. It's possible. Now for profit margin, I'm going to do 3.25, 3.75, and 4.25. So look what I did here, guys. I basically looked at their history and said, okay, what if they do a little bit better? What if they figure out a way? They save money on electric cars, whatever it is. They get more efficient and they do a really high profit margin, something they haven't done over the last 10 years. But let's go low. Let's say it's a new era for them. It's going to be low margin. And let's just see they do about what they're supposed to do, 3.6 to 4%. That's how I looked at this. Very simple. Now, free cash flow. Look at the difference between free cash flow and profit margin. Automatic red flag for me. I hate that. I'm going to focus on the free cash flow. Why? Because that's what really, the free cash flow is what's left over to buy back shares, pay a dividend, pay down debt, reinvest back in yourself, or make acquisitions. That's the lifeblood of the business. So why would I ever sit there? Earnings are great where the profit margin is, but you got to remember, earnings have SEC rules, GAAP rules, different accounting rules. So earnings can be different than the free cash flow, but they shouldn't be over long periods of time. Look how different this is over 10 years. I don't like that. I don't like that. In fact, a lot of value investors will say, if my free cash flow margin isn't 80% of my profit margin, they move on. But let's still go through the exercise to do this. So their margins have gotten better. So I'm going to call 2, 2.5, and 3. I'm going to go really high on this one. Let's say they figure it out and get there. Now, PE, not a fast growing business, not a high ROIC. That's why that's what I'd use to give a higher PE. I just sit there and say, oh, it's a fast growing business and it has a high return on invested capital. Give them a higher multiple because that shows me they have a lot of potential and they reinvest at a good rate. That's not happening here. So I'm actually gonna go very low on FedEx. I'm gonna go 10, 13, and 16. Now, I know you're shocked. Paul, what the heck, 10? Yeah, they have a crappy return on invested capital. They don't do a good job of investing their money. They do a terrible job of investing the money in the business. They're not getting a good return on that. I don't want to be involved in the business unless I get it so dirt cheap that I can take a value play for a little bit of time. I don't think maybe this isn't a long-term play. Let's see. And for my desired return. Now, guys, this is our margin of safety. This is our margin of safety. The more conservative I am, the less return I need. As I get more aggressive in my assumptions, I need to do a higher return. That gives me a larger margin of safety. I have beaten this thing up pretty bad here, I think. So I don't need as much return. But again, the high ROIC kind of bothers me. I'm still going to stick with 10%, 11. I'm going to do 12 and 14%. Those are big numbers over a 20-year period. That's going to make this shotgun a lot wider, okay? So I want you to remember that. Now, again, guys, that the point of this is you can put your own numbers in here all you want. You could think, Paul, you are crazy. What are you doing? You're being too conservative. Maybe I am. That's the point of this. So go to everythingmoney.com, check it out. $1 a day for 7 days. You can try all this, plus all of our tools listed here, and everybody in the community, thousands of people, like-minded investors that can help you understand these processes, because we're trying to teach a process, not trying to tell you, go buy the stock. We're teaching a process that you can apply to everything you do in life involving money. So let's hit the analyze button. And guys, don't hang up. Don't leave the video until we're done explaining the stock prices, because there'll be more to it. Hit the analyze button. Boom. All right. I'm looking at the cash flow method. We have a low price of 96, a high price of 166. Now, the interesting part here is this. The multiple of earnings on the high side actually isn't far off. It's actually there. And on the middle side isn't far off. But at the end of the day, what do you care about? I don't know. Maybe it's a discounted cash flow. So if you paid today's price and the low assumptions occur, you'd make about 2.34%. If you pay today's price and the middle assumptions occur, 6.81, the high price, you pay today's price and the high assumptions occur, you'd make 11%. So this is based on net income. So it's even worse based on discounted free cash flow. These returns are even lower. So guys, that's FedEx. It's a tough company to understand. For me, it's just a pass. Unless it's selling super, like if all of a sudden if you told me today, Paul, it's $70. Okay, let me do some more research on this. There are other better buys out there in my opinion. So please subscribe to the channel. Check out everythingmoney.com, $1 per day, 7 days. Thank you very much for your time.